Hello everyone. Today we will be talking about another very important ratio to evaluate a stock. Yes, we are talking about the debt to equity ratio. Debt to equity ratio is the total liabilities or debt or loan of a company, which is divided by the company's total shareholders fund, right? Now debt equity ratio is equal to the total debt which is divided by the total shareholders fund. A high debt to equity ratio, it indicates that the company is pushing its growth strategy by taking loans from the market. Whenever a company is borrowing money from the market, it has to pay interest on the loan and repay the debt. The advantage is that the company can get tax benefit from the interest it pays on the debt. A low debt to equity ratio indicates that the company is financing its growth plans from the shareholders' money or its own funds. Generally, an investor should prefer companies with low debt to equity ratio. Analysis of the debt to equity ratio should be done over a period of time and not in isolation. If over the period of time the ratio is increasing for a company, it means that the company is increasing its borrowing from the market. A very high debt to equity ratio indicates a high level of risk. Investors should be cautious before investing in such companies. Now, what is an ideal debt to equity ratio? The optimal debt to equity ratio will tend to vary widely by industry, but the general consensus is that an ideal debt to equity ratio should be 2 or less. Do remember one thing: repaying debt is mandatory for a company, while paying dividend to its shareholders is optional for a company. I hope that the video was informative. Thanks for watching, and do like, share and subscribe to our channel. Goodbye.